No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, got lots to share with you today. One of the things, when we're seeing the markets this volatile, it makes everybody a little nervous about what's going to happen. We're worried about it as and unfortunately, there's always that tendency, human nature, I suppose. It's different this time, and that's going to be really bad, and it's not going to recover. Let's put things into perspective. So first off, the market is down definitely this year. In fact, looking at it just before we got on, the most recent numbers, the market for first off, for the S&P, it's down about 13.5% for the year to date. The Russell, the small caps, are down about a little over 17% year to date. Dow is just under 10% down, and the NASDAQ a whopping 22% negative, over 22% year to date just this year. Now, we had a heck of a run up, so we have to keep in mind the perspective here being when you have as long and strong a bull market as we've had, with the exception of the little COVID break there, the market has gone very, very strong going back to 2009. So one of the things that we want to keep in mind then in that perspective is we're long-term investors, and we want to think in terms of the long term, how things are going to be over time. And here's some statistics I wanted to share with you as well. Over the last 70 years, corrections of at least 10% have happened about every year. About once a year. And corrections, or what we might even refer to as going into bear market territory of 20% or more, about every 6 years. So keep that in mind. In fact, to help with that, I've got a report, if you'd like to get it. It's called 6 Ways. This is from Virtue Capital. 6 Ways to Keep Calm During Turbulent Markets. If you're interested, just call my office and we can have Virtue send you one of these out. All right, so the number for the office, by the way, 615-376-5325. Now, I'm going to share some more reports and stuff with you, give you some opportunity. I want to go through a little bit, though, again, on that perspective. We've been talking about some of the factors involved, one of them being inflation. Some of the policies being pursued right now, unfortunately, are creating a lot of inflation, or creating higher inflation. Now, when we look, but again, let's get perspective. So if you'd like to see another report, this is on historical rates of inflation, and historical inflation rates, rather, from 1940 through 2020. And what we see is, if you go back about it, this kind of inflation we haven't seen in probably about 40 years. And reality is, if we calculated inflation the way we did 40 years ago, we'd probably have to go another 40 years back to see inflation rates this high. That being said, if you put it in perspective again, over the last 20 years, inflation's is run under 3% a year. So this type of glitch, if you will, the key is how fast can they tame it, and the longer it lasts, of course, the more that's going to play havoc with everyone when it comes to your savings and the rest. So that's report number 2 available for you. You recall, as far as inflation, by the way, I had shared articles. We've been talking about inflation, about maybe looking at TIPS, Treasury Inflation Protected Securities, as one option, has been shared on the show. Paul Tudor Jones wrote an article going back, this was Wednesday, October 2020. So, what is that, a year and a half ago? This was when we were first talking, shared this with you on air, and this got into inflation and his concerns, saying inflation could be worse than feared, biggest threat to the markets and society. Well, it's certainly playing out that way, as we're seeing. And then also another one from the financial education one, that was or Foundation for Economic Education, rather. Inflation hit a 13-year high, and of course it's just gotten worse. So we've been talking about inflation for a year and a half on the show, and how to prepare for it, some different things you can do. And we're going to talk some more about that. One of them being, there's some other pieces from Nationwide, understanding the business cycle, what to expect during a recession, because that's something else that they're talking about, even though Chairman Powell of the Federal Reserve had said, the economy looks a lot better, don't worry. Here's the key. When inflation's running hot, as it is right now, and you're seeing gas prices up, food prices, everything's up, right? What do? How do you, because your savings right? In particular, when you have prices going up and the market going down, and if your income is tied to your market portfolio, that's a definite danger signal, right? Because what's happening? If as interest rates are going up, the market's going down, right? Cost of things, inflation's going up, cost of things is more expensive, yet your income tied to your investments in particular, if you're having to sell more of your equities, as an example, to get the income you need, right, to maintain your standard of living quality of life, well, as you keep selling off more shares, even when we hit some bottom and it goes back up again, you're going to have fewer shares. So that means it's going to be a lot slower to try to regain what was lost, if at all. You know, in some instances, we refer to this risk as sequence of returns risk, and that risk can put you at danger of running out of money during retirement. So for that reason, I wanted to share some things with you to help you understand some things to look at. Now, one of the things I've talked on the show before is rules of retirement spending, okay? So this piece is from the Wall Street Journal. We've also got a piece from Morningstar. This is a huge report. If you'd like a copy of these, again, call my office and I'm happy to get that out to you. And it talks about what we referred to as the 4% rule. In particular, this came about back in the markets that we had back in the 80s and 90s. And it's at that time, there was a gentleman, and I think I've got his name here. Don't recall. Yeah, Wade Fall was one of the ones that did this study. Bill Bingen is his name. He was a certified financial planner. And he came up with this rule about the 4% rule, saying that you could draw down basically 4% from your portfolio safely with all the ups and downs and not have to worry about running out of money. Well, again, that was in the 80s and 90s. Now, that started changing. In particular, from 2000 through 2009, we had a negative return on the market for a 10-year period. That's like 5% of the time something like that happens. Very unusual. And that had everybody rethinking this 4% rule. And as the market has continued, even though we've had this nice run up, now the thinking is maybe more like 3.3%, and some even think below 3%. So if you'd like to learn, the point I'm going to make with this today, and again, if you'd like these reports, call my office. The thing I want you to understand is this. When it comes to your drawdown rates, there are ways to increase them. Okay, so they're saying not only, you know, the 4% rule, they're saying now basically like a 3% rule that you can only take down 3%. So if you've got $1 million, that's like $30,000 a year. You know, that doesn't seem like a lot of money for $1 million to safely keep and make sure you don't run out of money during your lifetime. Well, here's something we can use instead, okay? These are what are called fixed index annuities. I've talked about them a number of times on the show. I'm going to share with you this morning this report from Nationwide, Be Outliving Your Life, Not Outliving Your Savings. And we've got some future ones coming up as well, because I want you to really understand how this works for you and what it means, all right? Because what you can do with index annuities, one of the advantages that they can provide on income, and there are some other annuities that also specialize in giving income, is they can increase your drawdown rate and guarantee that money, that you won't run out of money during retirement. In other words, I've seen anywhere from 6 to 8% and even more on a couple occasions being able to draw down that much on your money, and yet with a guarantee that says even if your money went away, you're still going to have that income for life. So if you'd like to learn more about it, stick around. We're going to take a break. Join us here. We'll be right back on the Retirement Report.